I made a mistake in presuming that the self-interests of organizations were such that they were best capable of protecting their own shareholders. The words of Alan Greenspan. What if the policies weren't flawed, but the intentions of those who wielded them were? The human element. This is not just a story about policy alone, it's a story about people. Policies, whether good, bad, or flawed, do not act on their own. They are interpreted, implemented, and acted upon by individuals and institutions. And ultimately, it is our collective actions, whether as lenders, borrowers, producers, or consumers, that shape the outcomes. Yes, there were predatory loans issued to vulnerable borrowers. And yes, there were individuals who profited by taking advantage of low interest rates and flexible terms. The system is complex, and so are the responsibilities. Some individuals, equipped with knowledge and foresight, navigated the system to their advantage. But for others, lack of information or systemic barriers turned opportunity into disaster. This isn't just a story about greed at the top, it's about decisions made at every level, and how those decisions compounded into a crisis. In this series, we'll explore how these actions, whether driven by self-interest, ignorance, or greed, contributed to one of the greatest economic crises in history, and how, even in flawed systems, our choices can shape our outcomes. In the 1980s, a wave of optimism swept through the financial sector. Deregulation was heralded as the key to unlocking innovation, competition, and prosperity. The financial world was no longer just about deposits and loans. It was about creating wealth on an unprecedented scale. Central to this era of deregulation was the belief that the markets, left to their own devices, would self-correct. Alan Greenspan, who became chairman of the Federal Reserve in 1987, championed this vision. He believed that self-interest would drive institutions to act responsibly, ensuring stability for all. One of the most significant changes was the repeal of the Glass-Steagall Act in 1999. For decades, this law kept commercial banking, taking deposits and making loans, separate from investment banking, high-risk trading, and speculation. Its repeal allowed megabanks to emerge, combining both activities under one roof. These new financial giants claimed they could offer more to customers, more credit, more investments, more opportunities. But with fewer barriers, their risk-taking grew unchecked. Meanwhile, financial innovation exploded. Banks developed complex instruments like mortgage-backed securities, bundles of home loans, packaged together and sold to investors. The promise: safer investments, diversified risk, and a way to expand credit to more borrowers. And it worked for a time. Home ownership in the U.S. soared, and millions of Americans achieved what had long been considered the American dream. But as these innovations grew more complex, so did the risks. Mortgages were being issued to people who couldn't afford them, subprime loans. And those loans, wrapped in the shiny packaging of mortgage-backed securities, hid just how fragile the foundation had become. Alan Greenspan believed these instruments would spread risk across the financial system, making it safer. But as we'd later discover, the opposite was true. Deregulation and financial innovation promised stability and prosperity. Instead, they planted the seeds of a system vulnerable to exploitation, and those who understood this vulnerability would soon use it to their advantage, at a cost to everyone else. The financial world of the late 1990s and early 2000s was a place of extraordinary ambition. But beneath the surface of progress and profit, decisions were being made by banks, ratings agencies, and other financial players that pushed the system far beyond the boundaries of policy into the realm of greed. Banks like Countrywide Financial saw an opportunity. Policies encouraged expanding access to home ownership, but these institutions went further, approving loans to borrowers who could never afford them. These subprime loans were inherently high risk, but they were profitable, at least in the short term. To make these loans more palatable, banks bundled them into mortgage-backed securities. These were then sold to investors, often with little understanding of the underlying risk. It wasn't long before these unscrupulous institutions realized the more loans they issued, no matter how risky, the more profit they could generate from these securities. The system relied on trust. Investors depended on ratings agencies like Moody's, Standard & Poor's, and Fitch to assess risk accurately. But these agencies were paid by the same banks whose products they rated. The result? Conflicts of interest that incentivized inflated ratings. Junk assets, securities packed with subprime loans, were given the coveted AAA rating, signifying they were as safe as government bonds. This wasn't an accident. It required deliberate decisions to overlook clear signs of risk. By 2004, cracks began to appear. The FBI warned of widespread mortgage fraud, calling it an epidemic and warning of the impending fallout. Economists and whistleblowers raised alarms about the unsustainable growth of the housing market, but their warnings fell on deaf ears. Brooksley Born, head of the Commodity Futures Trading Commission, had sounded alarms even earlier. She warned of the dangers of unregulated derivatives as far back as the late 1990s. Instead of heeding her concerns, policymakers and financial leaders silenced her efforts, dismissing the risks. Policies intended to stabilize and expand markets were twisted into tools of exploitation. Executives tied their compensation to short-term profits, incentivizing risk-taking at the expense of long-term stability. Rather than protecting shareholders, these leaders prioritized personal gain. Compensation packages worth tens of millions rewarded them for decisions that would ultimately devastate the economy. The interconnectedness of banks, ratings agencies, and investors wasn't an oversight. It was a system intentionally designed to maximize profit. Greed turned what should have been a stable framework into a house of cards, with millions of lives hanging in the balance.
As profits soared for those at the top, the cost was borne by those at the bottom. When the collapse came, it was the ordinary citizens, homeowners, workers, taxpayers, who would pay the price. The policies that shaped the financial system from the 1980s to the 2008 financial crisis were not inherently bad. They aimed to expand opportunity, increase access to credit, and stimulate economic growth. But in practice, they created an environment where success depended on individual behavior, whether driven by discipline or greed. For some, this environment offered opportunities. Budget-conscious investors and disciplined individuals navigated the risks and reaped rewards. They made strategic decisions, choosing fixed-rate loans, living within their means, and taking advantage of low interest rates to grow their wealth. While policies were not specifically designed to reward these behaviors, those who maintained discipline found themselves in a position to benefit. Even during the collapse, some were able to hold on to their investments or buy assets at discounted prices, setting themselves up for future success. But for every disciplined investor, there were those who exploited the system. Policies that aimed to increase access to credit also created loopholes that could be exploited by those willing to cross ethical and legal lines. Lenders and financial institutions took advantage of relaxed regulations to issue risky loans, bundle them into securities, and offload the risk onto unsuspecting investors. While this behavior was not the intent of the policies, it flourished in an environment with limited oversight. The policies were not designed to enable fraud or deception, but the lack of strict enforcement gave those who chose illicit paths the freedom to act. This imbalance, between opportunity for the honest and freedom for the dishonest, amplified the eventual collapse. The financial crisis highlighted a harsh reality. While systemic failures created the conditions, individual decisions determined outcomes. Personal responsibility played a key role. For every homeowner who lost their home, another found ways to stay afloat or even thrive. This isn't to assign blame to the victims of predatory practices. It's to recognize the power of disciplined decision-making. Those who avoided overextending themselves were better positioned to weather the storm, regardless of the policies or market conditions. The policies themselves didn't dictate success or failure, they created a framework. What happened within that framework came down to the decisions of individuals, institutions, and regulators. Whether someone thrived or suffered often depended on discipline, foresight, and in some cases, sheer luck. As Greenspan's words suggest, even the best designed policies are only as strong as the people who interpret and act on them. And in the case of the financial crisis, the gap between discipline and greed became a chasm that reshaped the lives of millions.
The financial crisis of 2008 revealed the consequences of unchecked greed and systemic failures. It exposed how policies, when exploited by those acting in bad faith, can cause widespread harm. But even in flawed environments, opportunities exist for those who are disciplined, budget-conscious, and mindful of the market's realities. Policies intended to increase access to credit and opportunity created an environment where success became possible for those who approached it with discipline. By understanding the current market conditions, avoiding unnecessary risks, and focusing on long-term goals, individuals can navigate even the most uncertain times. For example, during the housing bubble, some chose fixed-rate loans, purchased homes within their means, and avoided the temptation to refinance excessively. These choices not only protected them from the worst of the crash, but positioned them to benefit when the market rebounded. This is not to excuse or overlook the systemic failures or the predatory actions of those who intentionally exploited the system. Banks and lenders preyed on the most vulnerable, offering loans they knew could never be repaid, all to generate profits. These actions were criminal, unethical, and devastating for millions of families. But even in this environment, the decisions made by disciplined individuals demonstrate a powerful truth: that personal choices, grounded in awareness and responsibility, can create opportunities, even amid flawed systems. In any economic environment, understanding the market and being mindful of its flaws can open doors. By staying informed, living within your means, and focusing on long-term goals, individuals can thrive, regardless of the policies in place. Disciplined actions, like saving during periods of growth, avoiding high-risk investments, and resisting the temptation to overextend, can turn challenges into opportunities. This is not to suggest that individual discipline is the only solution, or that it absolves those who acted with greed. Accountability for those who manipulated and exploited the system is crucial to restoring trust. But while the system adjusts and accountability is sought, individual actions remain a powerful force for change. The lesson here is clear. While policies and systems provide the framework, it's our actions, whether as individuals, families, or communities, that determine how we thrive within that framework. By choosing discipline, mindfulness, and accountability, we can not only protect ourselves, but also create opportunities to grow, even in challenging times. Let us acknowledge the flaws in the system, demand accountability for those who exploit it, and seize the opportunities available to us. Together, we can shape a future where financial success is built not on greed, but on integrity, responsibility, and informed decisions. The past teaches us valuable lessons, but the future is in your hands. No matter the flaws in the system, the actions of others, or the policies in place, the most powerful force for change is you. Your decisions, your knowledge, and your determination to succeed. It begins with understanding that no policy, no politician, and no system is responsible for your success. That responsibility belongs to you. Yes, we must hold our leaders accountable. Yes, we must vote for policies that promote fairness and opportunity. But regardless of who's in office, it's our choices that define our outcomes. Take the time to learn how policies work, understand how money works, empower yourself to make practical, informed decisions, because no one else, not a politician, not a financial institution, will do it for you. Your family's future, your bills, your wealth, those are in your hands. The good news is that no matter where you are now, opportunities exist. You can learn to budget. You can grow your wealth. You can make decisions today that will set you up for success tomorrow. The system may not be perfect, but there are always ways to thrive within it. Be frugal. Be disciplined. Take advantage of the tools and resources available to you. Build a foundation for yourself and your family that no policy or crisis can shake. And if you're looking for guidance on how to do this, you've come to the right place. At BNV Finance Fixers, we're here to help you understand the system, learn strategies to grow your wealth, and take control of your financial future. You don't have to do it alone. Join us on this journey to better understand, better plan, and better succeed. The path to financial success isn't always easy, but it is always possible. Stay informed, stay disciplined, and remember, you have the power to shape your future. The opportunities are there. Now it's time to seize them. Thank you for spending your time with us here on BNV Finance Fixers. We're passionate about sharing our expertise to help you build wealth, develop strong leadership skills, and cultivate a growth mindset for budgeting and life improvement. Your journey to financial freedom starts here, and we're honored to be part of it. If you found value in today's content, don't forget to like, subscribe, and hit the notification bell so you never miss an update. Join our growing community, where together we're redefining success and transforming lives. We can't wait to see you in the next video.